frank. So I'm sure between us, if you have any questions at the end of the session, we'll be more than able to answer those questions. Today's subject is regarding a very important part of just about every business, which is it's about liquidity, credit risk, and protecting yourself from events regarding insolvencies, and how NCI, and I'll tell you a little bit about NCI just very briefly, how NCI can assist in those areas. NCI has been going for, it's our 30th birthday this year. It's head office in Adelaide, and we have branches around Australia, New Zealand and Singapore. We specialise in the receivables space, and I'll go into that in more detail, and it's really everything to do with receivables. Managing risk, it becomes more complicated by the year. The last couple of years we've had new legislation with regards to the Privacy Act, and probably one of the biggest changes to giving credit regarding the PPSA, or the Personal Property Securities Act, which really has taken away what used to be the old retention of title. And just as a quick overview, retention of title used to be where the goods remained the sellers until such time as they've been paid for. Now, unless that is registered, unless you have the rights to register and it's on the government register, you have no retention of title whatsoever. But we'll go into that maybe a little bit further. Just on the PowerPoint there, you'll see that one of the things that we do when we look at credit risk, we have a look at the procedures. It's important to understand your own receivables. If there are some people in the print industry that operate with primarily a large number of small customers, so obviously if you have a limited exposure to large accounts, then the damage to your business can be minimised a little, which is the exact opposite to a company that might be doing most of its business or credit transactions with a limited number of customers, and the individual exposure to those customers, if they fall over or if they can't pay, can be quite devastating for many businesses. So it's important to understand your own client risk. NCI does reviews of major customers. We've got a unique database. We can arrange the PPSR, but again, I'll go into these things a little bit later. But it's all about that receivable space and trying to mitigate the risk. And if you're in the print industry or associated industries, I'd suggest that there'd be very few of you that haven't felt pain associated with having one of your customers fall over. Let's just talk about the PPSA, which I touched on before. The cost of registering for PPSA is relatively cheap, somewhere around the $8, $10, $12 per registration, depending on the period that you want to register for. But there are a lot of people trying to do registrations themselves. You can do it yourself on the ASIC website, but it's like, in my opinion, it's like most government things. It's a very messy website and it's very difficult to understand. And we've had a number of clients who come to exercise their rights under the registration, only to find that they put it in the wrong box and they've got no security at all. And some of those errors have cost them hundreds of thousands of dollars. So it may only be $10 or $8 to register, but if it's not registered correctly, then basically it's just a waste of money. The other thing that's happening is that liquidators and receivers are trying to work around providing goods back. So they're going into it quite aggressively with wanting to know on what basis do you have the rights to register your security interest. and that comes back to your credit applications. So if you have a credit application and it doesn't allow you to register for PPSR, then when you come to realise your security, it won't be valid. So you need to have an up-to-date credit application, and when you change your terms and conditions or you get a new credit application, you also need to re-register your security under PPSR. There's a lot of people out there who are of the opinion that if you have a registration, that it's enduring, but if you change the terms and conditions, you need to re-register your security interest. And we've got a number of clients who've got hundreds of credit applications from many years. They registered their security. They've since gone out and obtained new credit application forms, and they're all having to register those new credit application forms or the PPSR interest under those new credit application forms. What NCI can do to help that is on the screen there you'll see a mapped out process. First of all, we can do a data wash of a company's receivables. So we basically feed it into our system in an Excel spreadsheet form. That's linked into ASIC and other databases, and it will actually come back and it will say, for example, of 100 companies that's on your receivables, 20 or these 20 or whatever, either the registration number is incorrect or the spelling of the company is not right, or the company no longer exists. So we find on average, when we look at a receivables ledger, there's about 20% of the entities that are inaccurate. So obviously, unless we can get that accuracy fixed up, then any registering of security under the PPSR is wasted. So what we do is we get the receivables, as I mentioned, we'll put it in, we'll register the 80%. For you, if you like, make sure that the debtors are matched, and then we can register for the PPSR. And whilst we're doing that, you can work on trying to match the debtors where there are the imperfections, if you like. So that's PPSA. So if you have any questions, if you could email those through to Yoshi, and we'll come back to those. Our broking services, we place about 65% of all the credit insurance in Australia and New Zealand. And I won't go into any great detail other than to say credit insurance is effectively a policy that covers you against goods sold and delivered. In print industry, it would normally be on 30 days from end of month of delivery, sometimes 60 days. And when a company goes broke for $100,000, there's a policy in place. Premium is calculated on the risk, the loss history, and the turnover. And about 90% of a claim or a debt can be covered by insurance. There are minimum premiums that apply, but in terms of the rates of credit insurance at the moment, they're probably at the lowest premium levels they've ever been. And I've been doing this for 25 years. Frank, I don't know how long you've been doing it.
Close to about 35.
Yeah, and the rates are probably a third of what you would normally expect. So if it is something where you have some large exposures that could hurt the business, it's certainly a good time to be looking at it. NCI has a number of analysts. We can provide credit reports. We don't just work on algorithms. We actually have people that get the information and then assess the information. We do have the ability to do algorithms, and whilst we're not there yet, it'll be very soon where we'll be able to offer print industry members an opportunity where you can have a credit application form on your website, and without the client knowing. It can be filled out, it will come to NCI. We can actually, in most cases, by return, have done the research, linked into asset, linked into adverse information, and almost instantaneously send you a response to say, yes, this customer can be covered for, is good for $50,000 under this matrix, or $25,000. You set the parameters. It can be used to support your discretionary limits under credit insurance. So, you know, we do the Dun & Bradstreet type things. We don't compete with Dun & Bradstreet. The likes of Dun & Bradstreet and Vida are very, very good at collecting public information, downloading from courts of what summonses and winding up notices and things of that nature. NCI buys that information. We don't try to reinvent the wheel. We buy that information from the likes of Dun & Bradstreet and Vida, and then we cross-check that with our own records. And our own records show things like there's a winding up order going to be released going to be issued against this customer in 14 days if we're not paid. So we work very, very differently. We work on trying to provide early warning signals or early advice to help people manage the risk. We don't tell clients what they should do, but if you're looking for information on a buyer, I'm sure you'd all agree that it's very handy if you get the information that tells you about the business, but then we also tell you that you should be aware that we've got clients that have repayment programs and some cash flow issues, or we have a number of customers who are threatening to wind them up over the next 30 days if they don't get paid. That's what's unique to NCI. To the best of my knowledge, the NCI database is the only database of any size within Australia and New Zealand that can provide that information. I think going through the previous slide, I've gone through most of this, but basically it's about the risk management. It's about information. It's about having access to information that's unique and early enough to be able to make a difference. We can tell you that a company went broke yesterday, but we'd like to tell you the month before that the company may be going broke, so that you can actually have some options to be able to manage that risk or mitigate it. Recommend assessments and recommendations, we can do all that, do the credit reports. For as little as, I think it's $50 a buyer, you know, if you're a printing company and you look at your ledger and you're doing $2, $3, $4, $5 million of annual turnover, and you've got, let's say you've got 20 key customers, you can actually lodge with us those top 20 customers, and we'll actually provide you, we'll monitor those customers and provide you with any early warning signals or whatever that we get. One of the things that we do find is that print industry, a bit like media, often suffers a little bit in that you'll get dragged out for payments. If it's a company that needs ongoing materials, they have a vested interest in making sure that the accounts are paid 30 days each month to continue supply. We often find in media and printing that once you've done the print run and you've done the exercise and they've got what they need, the incentive for them to pay you ahead of other suppliers is somewhat diminished. So the management of debtors or receivables in print is very important, and that monitoring can help a great deal in that respect. What is credit insurance? Protects you against insolvency, protracted default. These days we've got some clients who pay premiums and they receive considerable benefits from the payments of collection monies or litigation to collect the monies that can often be covered as part of the insurance. couple of things that people don't take into account when they consider the question of credit insurance. We have very few clients who have credit insurance who don't grow their business beyond what their expectation was. We have some clients who say that the cost of the credit insurance, and if you were to say it was 0.3%, or between 0.25% and 0.5%, or depending on the size of the business. We've got clients who say that they've grown their business by 40% and the cost of the credit insurance is actually cost neutral. If they don't have a claim and they never receive a claim payment, the fact that it supported their growth and allowed them to grow with confidence, knowing that if that customer who owes them $400,000 goes broke, that they're going to receive 85 or 90% of the money back. You know, if you're working on a reasonable margin, it doesn't take a lot of additional sales to recover those premium costs. And of course, you know, the insurers and National Credit Insurance are looking at those key buyers all the time to try and make sure you're dealing with the right customers and not the customer that somebody else is threatening to sue or that type of thing. What does credit insurance cover? Primarily goods and services. Sometimes there can be pre-delivery risk and things like that. But when you're looking to put a credit insurance policy in place, it's not an off-the-shelf product. It does need to be tailored to suit your business. We do need to meet with you, make sure that in the event of an insolvency, everything where you have an exposure is going to be covered. And we catch up with our clients on a quarterly basis usually to make sure that all the compliance issues are covered off. I don't know that there'd be a huge market in print and associated products for export, but there's a lot of exporters that credit insure because when you send goods overseas into other markets, you've got limited knowledge and limited access to recover those funds. So from a cradle to grave scenario, we help clients with their credit applications, make sure that it's got the latest documentation in with regards to the PPSA and the Privacy Act. And the penalties for breaching the Privacy Act of personal information are very heavy. And at the end of the exercise, through the credit insurance reporting, we actually have two debt collection companies. Debt collection companies specialise in different areas, and we do have a collection company that specialises in printing, food and steel. Now I think, Frank, do you want to, before we go into any questions, do you want to add anything to that I may have missed?
Not necessarily add anything, but maybe if I can just summarise a couple of the key points. The thing to remember is that NCI is a one-stop shop for all things credit management, collections and reporting. It's not a case of selling all the products, but it's finding which ones are required and tailoring a program to suit your needs. We do that after an evaluation of your business. We understand your business, and then we provide you with the appropriate options to consider, making sure they're both cost effective and basically suit your need, suit what you want to get out of the program. The final thing is, if you want to wrap what trade credit and what collections and everything is all about, just think of it this way. If you had a debt of $60,000 and your business was operating on a 5% margin, effectively you'd have to turn over an additional $1.2 million in the year just to square that off. And you can all appreciate in businesses to get generate $1.2 million worth of sales is a lot of work and a lot of heartache just to get back to your original position. This is what the suite of products can actually do to improve your business.
Yeah, terrific. Okay, Yoshi, is there Can you tell us if there are any questions there for us to answer?
Yep, we've got a few, so I'll just remind everyone and some people who came in late. If you would like to ask anything, please just type it into the questions box. It's located between polls and handouts. I'll see those and read them out for you. So the first question that I have is, how much does it cost to have a customer report done?
It really depends on the depth of the report. I think if it's just a primary report and it's a full report, somewhere between 150 and 200. But we can, if we can get the person's details, we can actually send a price list for that. But there's a whole range of different reports. I think you can get very basic adverse checks to, full investigative reports that are $300.
Thank you. Next question is, does NCI offer any discounts for Printing Industries members?
I'm sure that we could do something if there was some interest.
Short and sweet, thank you. And I think this is the last question. So once again, if anyone wants to ask anything, please jump in. Oh wait, one question has definitely come in. Are the legal costs for debt recovery included in the insurance?
Right.
There is some of the insurers offer anything from a 50 to 100% recovery of the legal costs, but that also has the requirement of having a policy and having the claim being valid. This is where having a broker and having a specialist manage it from approval to claim is critically important. So yes, there is cost recovery depending on the insurer. And they vary between the insurers.
The insurers like the collections actions to be taken within a certain time frame, and the reason for that is that the reason that they're paying for the litigation costs and the collection costs is that they're hoping to avoid a claim down the track. So anybody who's in credit would understand that the sooner you act upon a debt that is overdue, the more likelihood you are of getting paid. If you leave it longer, the chances of recovery of that money drops significantly.
NCI are also across all the insurers in terms of their requirements for recovery. So having NCI do the collection in line with the policy will basically assure you that you'll get the maximum return as required by that insurer.
Thank you. So it looks as if I have just one more question, but again, if you would like, no, every time I say that, another question pops up. Okay, at least two more questions. Here's the second last one. How long does PPSA registration last?
Well, there's a range of years, and I must admit I don't know what the extent of them are, but I know that I think most of our clients do it for 3 years, but I think you can do it into perpetuity.
Yeah, I think you can. There's a separate cost for obviously that length of registration.
Yeah, I think for 3 years it's about $10 a registration, but there are other options longer that are more expensive. I want to say the significance of PPSA registration can't be overstated. I mean, there are circumstances at the moment where there are just huge issues around PPSA. It's been very poorly legislated. The wordings are very confusing. There hasn't yet. There's a number of test cases in the air going through. There's a couple of large turbines that were provided to a company in Perth called Force. Force fell over. They were in the mining industry, and I think the turbines were $25 million each. And it was a company from America that supplied them. Receivers were appointed. The American company hadn't lodged any registration, and the receivers have said, "Well, thanks, guys. Those are my two turbines worth $25 million." So we haven't seen a lot of test cases, but we're seeing some big ones where the people are sort of saying, well, it's commercially, it's worth our while to spend the money to have the test case. But receivers and liquidators are being very tough, and if you want any materials back or goods under PPSR, remember that in print you may want limited access to goods back, but under the PPSR you also have access to claim against the monies that are received from the sale of your product. So it's not just the return of your goods. Sometimes in printing, if you're doing, I don't know, if you're doing corporate brochures for somebody and they fall over, well, those brochures are absolutely no use to you. But you do still have the rights to lodge a claim on the funds that may be generated from the sale of those, that the receiver makes for the sale of those brochures. We can, if anybody would like a PowerPoint on the PPSA, by all means let us know and we can send you something.
Thank you, gentlemen. I'll pass that on. And the next question is, if I have bad debtors now, can I get NCI to chase them on my behalf, and what is the cost of this?
Certainly you can. We work on a success basis, so if we don't collect the money, you don't get charged a fee, and the commission rate is 10%. So it's a worthwhile exercise. If it's not going to cost you a cent, provided that we don't collect it. Obviously, our success rate is quite high. I think we've got a success rate of about 80%. But again, that success rate varies on how early it is that these accounts are passed to us to collect. We do get some accounts given to us to collect that are a year old, and naturally the success rate of those is far less than those accounts that are passed to us when they're at 90 days or 120 days.
Thank you. Next question is there a standard credit period that the industry uses? I need to know how my terms and conditions compare with other printing companies to know if I am good or bad.
I don't think there is a good or bad. I think it's really down to your commercial position. I know there are some clients who demand 45 days or 60 days, and if you don't meet that requirement, then you don't get the job. I think generally in printing and associated products, it's 30 days from end of month delivery. But in saying that, there's a number of them that wouldn't chase any monies until 45 days, and there are some that chase them at 1 day past 30. There are also others that don't chase their accounts until they're 60 days. So, it's a very widespread, but as a generality, I'd say most people are on 30 days from the end of month of delivery.
Great, and this next question that I have is a bit of a comment rather than a question, but I'll just read it out. Years ago, printing industry circulated a monthly list of reported industry bad debts so that other printers wouldn't get burnt by this person or company. It was a great warning system. Could printing industries look at doing something like this again? I will definitely ask within the printing industry's office to see if that's something that we could do. But gentlemen from NCI, do you offer a service like this, or is that something we could look at?
You can, but you've got to be very careful about issues of privacy and collusion. Most of your clients' customers would be in the commercial areas, so you've got a lot more flexibility than what you can in retail or consumer. But you cannot be seen to collude to drive somebody out of an industry, and you can't work together to take an approach to not supply somebody. What you can do is you can actually ask, what the trading experience is and whether or not there are any payment difficulties and stuff like that. But as long as you don't collude to an outcome, then you can do it. NCI operates a steel bureau where we have a number of clients in the steel industry who get together on a I'm not sure what the regularity is. I'd suggest it maybe 3 months, and they look at accounts of which they're having issues with. But again, it needs to be very carefully controlled and monitored.
Okay, would it be possible then to put out a list of quote-unquote payment difficulties?
Customers with payment difficulties.
Yes, I think so.
No, it wouldn't, unfortunately. Within the print industry may be able to do something, I guess, but it would be fraught with danger. You'd have to be very careful.
Most of those industry bodies for other industries simply have a discussion across the table about experience, as Terry pointed out earlier. I think that's probably, to be blunt, the extent that you would take it.
Remember that if you're an NCI client, and we actually become aware of somebody with payment difficulties, whilst we wouldn't divulge the name of a customer who's having some payment problems with a common customer, we do have analysts who ring our customers and say, we know from our system that you're trading with XYZ, and you should be aware that we're receiving information that there may be some cash flow issues. You may want to have a look at that. So it's not a bureau, it's not limited to an association or anything like that, but the end result, if you're an NCI client, we know who your clients are for one of our products. The end result is very similar to what you're talking about in a bureau.
Thank you. You've just had one more question come through, which is, many of our clients are regular businesses. Can we track their debt performance before we agree to give them credit, and what would this cost?
Could you read that out again, Yoshi?
Sure. Many of our clients are regular businesses. Can we track their debt performance before we agree to give them credit, and what would this cost? I can ask this person to clarify if that wasn't clear.
Well, can I just make the point? One of the, and it's probably, the smaller the business, probably the more guilty businesses become. One of the misconceptions is that, there's a couple. One is that if it's a household name, then you probably don't have much of a risk. I'm not quite sure how many of you would know, for example, that Target in Canada fell over this year, and all their suppliers look like getting virtually nothing in the dollar. And that's Target. We have many customers in Australia who say with their credit insurance, we won't insure Target because it's a multinational, they'll never go broke. Well, Target in Canada did go broke. In your industry, I'm just trying to think, I'm struggling, but Paper UK, Paperlink, is it Paperlink?
Yep, sounds familiar to me.
Yep, in the UK. It's a public company, it's around the world. Decided that they've been carrying too many losses in the UK for too long and cut off their UK business. And it's probably a company that all you in the printing industry, if you're buying paper, you would probably be buying from them. And because it's overseas, you wouldn't dream that they would just cut off a division or a company. And again, so people go broke that you really wouldn't expect them to.
Just on that point too, what is a growing trend is private equity. And private equity is where you have a financiers or groups of companies that collect all this money and invest into businesses, and some of them are household names. And the difference between an owner running a business who's established that business from scratch and a financier coming in who simply has shareholders who want the return on their money is that they can pull the plug on that pretty quickly. If the numbers are not going the right way and their investment return is not meeting expectations, there's always an option of putting money in or taking money out. Or when you've got a lot of investors, you've got to look after their interests and not the interests of the business. To close down a well-known name is not unusual. There have been a few of those cases over the last 3 or 4 years.
The other misconception is payment history. Everybody, and I must admit, when I was on the other side of the desk, I used to have a similar opinion, was that if somebody's paying you 30 days, then you're probably okay. You need to concentrate on the ones that are slow paying every month and 60 days, and you've got to fight to get your money. That went out the door many years ago. We got some customers, we've got many claims that come through us where the account's not even due for payment. the decision to pull the pin has been driven by the taxman or the taxman, or I'm trying to think, it's gone off the top of my head, but the taxman does it, or the financier sees that their projections are not going the right way. They've been struggling for a couple of years, and they've got the assets at the moment to recover the borrowings, so they just pull the pin. And once they lose the bank support, obviously it all goes crashing down. So that misconception that you've got a good customer because he pays 30 days may well be the case, but we're also seeing we're getting at the moment, we're getting in excess of 100 claims a month. I would estimate that of that 100 claims, probably 70 of them are either 70 of them would be, when they fall over, would be under 45 days. So prompt payment isn't a guarantee of getting paid in the longer term. What it does do is it reduces the debt.
Thank you. And the next question that I have is, can you please talk a bit about trade references? Is there any information you cannot legally give out about a client?
Again, there's two issues here on whether it's consumer or commercial. If it's consumer, personally I wouldn't be doing it. The Privacy Act is just fraught with all sorts of restrictions and whatever. If it's commercial, then you can give out trade references. A lot of people are of the opinion that when the Privacy Act came in that you are able to give trade references, but they must be factual and they must be accurate. As long as you stay on the straight and narrow and you just stick to the facts, you can give them out. What is happening though is there are fewer and fewer companies who are prepared to give them out. So obtaining good references when you're assessing credit risk is becoming very, very difficult. There are companies out there, or multinationals, who just make decisions. We will not ever now give trade references because it takes up too much of our people's time. And the other argument to that, of course, is how often does somebody actually give you a trade reference that they know is going to indicate that they're a slow payer or a poor payer. Usually they'll give you the trade references where they're good payers.
Just on that too, because of the legislation, because of the difficulty, time consuming and lack of references on offer, this is why products in the market such as the reporting that NCI, Terry mentioned earlier, that NCI offer become both a substitute as well as coverage, and more of our clients are moving towards not having to worry about making that phone call and having someone spend half a day getting references, waiting for a return, and having to make a decision, and prefer to be able to make a request for coverage, have that coverage in place within as little as an hour to as long as 48 hours, and then be able to make a firm decision to supply or not supply on the basis that it has gone past some modelling, which is based on a lot of information, both historical as well as current, and that would give a probability of either a positive or a negative that it will or won't become insolvent. So if the probability is high that it's not a good risk, it'll be a nil. And if the probability is that it is a good risk, you get the limit endorsed. So then you can commence to trade. And that has been a change in the industry over the last 5 years.
Great, thank you, gentlemen. And it seems as if there are no more questions, so I guess we'll wrap the webinar up there. Thank you very much to Terry and to Frank from NCI. Thank you very much to all of our attendees. Once again, if you missed this webinar, or well, you wouldn't be here if you missed this webinar, but if you missed any previous webinars, we do have a webinar hub where all of the recordings are put. If you are a member, please just visit our website and log in. If you need our details,